Okay, great. So good morning, everyone. Thank you to the organizers for giving me the opportunity to speak at this conference. It's obviously a great honor and privilege. I mean, going after Laura Starks is a difficult task, but I'm going to do my best to provide an interesting talk. So today I'm going to talk about the value implications of sustainability, or more generally the question of whether sustainability or pursuing sustainability-oriented objectives creates value for investors. Now, let me start by saying this is not a new question. Okay, so this is a debate that has been led, that has been held by both investors, policymakers, but also the public opinion, at least since the 1970s. Okay, so sort of on the one hand of the, let's say, ideological spectrum, you have sort of the Friedmanites. Okay, so Milton Friedman famously declared in his in an op-ed in the New York Times magazine in the 70s that the only purpose of business was to pursue corporate profits, and kind of suggested that pursuing environmental and social objectives was incompatible with corporate profits. Actually, if you look at that essay, Friedman goes even further. Okay, so he kind of suggests that pursuing sort of responsibilities for providing employment, eliminating discrimination, or avoiding pollution is sort of akin to preaching pure and unadulterated socialism. Okay, so obviously socialism is a much worse word in the US than in Europe, but still, I mean, it's a pretty extreme viewpoint. Now, on the other side of the ideological spectrum, you have another Milton, but who's probably much less known to you. So on the other side, you have Norton Moskovitz. So Norton Moskovitz used to be a business journalist based on the West Coast in the United States, and he sort of was one of the first individuals to investigate the financial performance of socially screened portfolios. And he's also the father of the 100 best companies to work in America list. Okay, this famous ranking of workplaces that now exists for many different countries in the world. And he sort of thought that in order to provide, let's say, sustainable corporate profits, it was very important that managers pursue also social objectives. Okay, so when it comes to sort of public opinion or debate by op-ed writers, there seems to be disagreement. Okay, so there seems to be disagreement about whether pursuing environmental and social objectives leads to higher profits or leads to value for investors or not. Now, a natural thing would be to look at what does science say. Okay, so what have researchers said regarding that question. Now, again, there are sort of naysayers and yes-sayers. Okay, so again, there seems to be disagreement about whether sustainability objectives lead to higher or lower performance. Okay, so to, let's say, quote a couple of the naysayers, there's a paper by Hong and Kasperczyk that shows that, let's say, stocks from deeply unsustainable sectors, such as alcohol, tobacco, or the gaming industries, earn higher expected returns than otherwise comparable stocks. Okay, so it's sort of evidence that says no, sustainable objectives would lead to underperformance. Now, there's another paper that's going to be presented tomorrow at the conference that finds that mutual funds with better Morningstar sustainability rankings, okay, sort of a fund level ranking, do not outperform financially. Okay, and another paper that has found, looking at the performance of responsible investment funds, that both in the US and the UK and in many European countries, and Asia Pacific as well, socially responsible mutual funds underperform. Now, this is obviously not a complete list of the evidence. There are many more papers suggesting that there is a negative relation between sort of pursuing environmental and social objectives and investment performance. Now, as I said, there are yay-sayers as well. Okay, so for instance, in an influential paper published very early, I think, in 2005 in the Financial Analyst Journal, Derva, Gunster, Bauer, and Kodak find that a portfolio of companies ranking high on environmental issues outperforms a low-ranking portfolio. Okay, now there's another paper by Alex Edmonds, who's going to speak in the afternoon here, who shows that a portfolio that is based on the very list of Norton Moskovitz, on that list of the best companies to work for, earns a significant alpha between 1984 and 2009. And then there's another paper, by Eccles, Joannou, and Serafine that has shown that sort of a portfolio of high-ranking companies in terms of sustainability has outperformed a portfolio of low-ranking companies between 1993 and 2010. So again, there are more papers showing similar results. Now, there's kind of a problem here now. So sort of, public opinion is divided. They're the Moskowitzes and the Friedmanites. Then, there's scientific research showing, that there's a positive relation between performance and ESG or sustainability. And then there's research that shows the complete opposite. Okay, now you may ask, is there perhaps sort of an aggregate scientific consensus? And luckily there is. Now I had planned to ask Alexander Bassen, who was supposed to appear in the panel just after, to come up now and talk about his paper, but unfortunately he missed his flight. So I kind of feel a bit less ashamed just sort of, citing from the abstract of his study. So he has written, I think, an interesting study, a meta-study that sort of aggregates a lot of the published empirical work on this question, on the relation between sustainability and performance. And I think his message is quite positive, because he provides, by aggregating these 2,000 different studies, he finds that a large majority, actually 90% of all studies, tend to find a positive relation between a non-negative relation between ESG and corporate financial performance. And more importantly, he also shows that the large majority of studies reports positive findings. Now, we could have sort of, perhaps stopped here, but I still have to talk for, I think, another half hour. So what I'm going to do now is I'm going to sort of draw on some of my own research and research from other scientists as well, to highlight a couple of issues that I think are important when thinking about the relationship between performance and sustainability. And the first point I would like to make is really about this idea that the stock market might not always reward sustainable corporate behavior, but I think there is strong evidence that the stock market punishes unsustainable or extremely unsustainable behavior. Okay, and so to illustrate this point, I refer to a paper I've written in my PhD, and that I luckily published in the Journal of Financial Economics, where I study how the stock market reacts to positive and negative sustainability-related events in the very short run. Okay, so I construct a data set of about 2,000 sustainability-related events. Okay, so these events happened during 2001 and 2007 and concern US stocks only. Okay, so this is a US-centered study, and essentially I conduct an event study which is, which is a methodology allowing to analyze whether the stock market sort of systematically reacts in a certain way to a certain kind of events. Okay, and essentially what I do in this paper, I analyze positive and negative events separately. Okay, so I have events that indicate positive sustainability and events that indicate negative sustainability, and I also separate it into different categories. Okay. Now, just to give you a short feel of the data, okay, that this might be a bit small. So essentially, I have about 600 positive events, okay, and about 1,600 negative events that are kind of, not evenly, but which are distributed across these different issue areas. Now, to give you an example of a negative event in this data set. Okay, so this is sort of pseudo-representative, but obviously they are not all these kinds of events. But just to give you an example of the kind of events I analyze, so this is an event that was taken sort of from the environmental issue area, okay? And this was an event that concerned Apple. Okay, so Apple in 2006 was targeted by an NGO for its environmental policies. Okay, and in particular, Apple was criticized that it didn't have good take-back of electronic waste or scrap policies. Okay, so this event happened in May 2006, belonged to the environmental area, and I have this little description of the event. Okay, now, an example of a positive event, you're going to see that they are quite different, the positive ones, is this. So this is an event that concerned the company PNC. Okay, so PNC was included in this ranking of the best companies for working mothers. Okay, so kind of was recognized of having very good employment policies. Okay, and so this event belonged to the diversity issue area. Okay, so just to give you two examples. Now, for the one point before I talk about the main results of this study is, besides the obvious fact that some of the events are positive and others are negative, the information content in these positive and negative events is very different. Okay, so what I did is I did sort of systematic textual analysis on these small event descriptions. So I tried to, see whether the language describing these events, differed in systematic ways. Okay, and essentially, compared to positive events, negative ones contain much more legal and quantitative information. So I think it's fair to say that sort of negative events, so events of negative sustainability or poor sustainability, tend to be based on more hard information. Now, the main result in the paper was that sort of the stock market reacts very negatively to negative events. Okay, so this idea I'm trying to bring across that the stock market punishes unsustainable behavior or evidence of unsustainable behavior. Okay, so I found that these events, these negative events, were followed by about 0.8 or 0.9% negative abnormal returns, okay, over an 11-day period. And the strongest reaction was when these negative events concerned the environment and communities. Okay. Now, in contrast to this negative reaction, okay, so this is kind of consistent with the view that unsustainable behavior is sort of costly for shareholders. Okay. Now, in contrast, there's no strong systematic reaction to positive events. Okay, so there's really this tension between the stock market reacting quite clearly, quite negatively to unsustainable behavior, whereas sustainable behavior is not necessarily rewarded. Now, this has been, I think, confirmed by an interesting recent working paper by a German PhD student from Eichstätt, Simon Simon Glossner, who has looked at not the short run, as I've done, so I've really looked at sort of, the immediate market reaction, but at the at longer run returns. Okay, and this paper essentially says that a value-weighted portfolio of controversial firms, so essentially firms with a known history of negative sustainability or unsustainable behavior, earns a negative alpha between 2007 and 2006. And this is sort of robust to controlling for other risk factors, industries, and firm characteristics. Which brings me to sort of the second point I'd like to bring across today, which is that certain stock level characteristics that have predictive power for stock returns, okay, or for corporate policies in general, correlate in a non-negligible way with ESG measures. Okay, so there is, let's say if you, I think last week there was another study stating that, an ESG index outperformed a regular market index. You should bear in mind that, when you sort stocks on ESG, you are implicitly sorting on certain firm level characteristics that have been shown to have predictive power for stock returns. Okay, so to illustrate this point, what I did is I looked at US stocks, okay, between 2002 and 2015, and I used environmental and social scores from 2 commercial data providers. Okay, and essentially what I did is I rank transformed them, I made them comparable, okay, so I transformed them to have a sort of to lie between minus 0.5, so these are the stocks with the lowest environmental and social scores, okay, to 0.5. So these are the stocks with the highest E and S scores, okay. And then the idea is really to show, how do these scores relate to known characteristics that predict the cross-section of stock returns, okay. And the characteristics I focus on are quality, okay, or gross profitability, which has been shown to be a strong predictor of stock returns in a recent paper by Novi and Marx. So I've focused on market cap and book to market. Okay, and just to, this is a very simple empirical analysis, but it's important to convey this notion that stock ESG criteria or ESG scores, they do correlate with certain firm characteristics. Okay, so what you find is so these on the left-hand side are really the firms with the lowest profitability. Okay, so the lowest quality, and on the right hand side here are the firms with high quality or high profitability. So you do tend to find that low quality firms, so sort of sortings on profitability, tend to have low ESG, E and S scores, whereas high quality firms tend to have high scores. Now you find similar relationships when you look at size or market cap. Okay, so there is this huge bias to some extent in ESG scores, to the extent that small firms have substantially lower E and S scores than large firms. Okay, and to think along the lines of another important sort of predictor of stock returns, if you sort firms by book to market, into low and high book to market firms, you tend to find that growth stocks tend to have better E and S scores than value stocks. Okay, so I think this is important, to bear in mind when somebody comes to you and tells you, okay, so this E and S sector index has outperformed the general market over a certain period. So you can't just analyze them by themselves. Okay, and so to some extent, if you think of it in terms of a performance, from a performance perspective, this begs the question of whether ESG is first or second order, right? I mean, it might be, second order to the extent that the real value is perhaps in using, ESG criteria in conjunction with other stock characteristics to improve quant strategies. So for instance, you could focus on small firms with high environmental and social scores. That might enhance returns even further of small firms. Okay, now the third point I'd like to bring across is that the value implications of sustainability might depend on the context. Okay, so it might be that on average, sustainable behavior does not generate value, okay, does not enhance profitability, but perhaps it does for a subset of firms, okay, or conditional on a certain characteristic, okay? And so I like to go back to my JFE paper where I push this idea of offsetting sustainability, okay? So the evidence in the paper points to the fact that stock markets do not react systematically to the occurrence of positive events. Okay, so when information about positive sustainability becomes available, there's no systematic stock market reaction. However, if you condition on firms having a known history of poor sustainability, you'd actually do find a positive reaction. Okay, so this suggests that perhaps when a company has poor sustainability and you work to improve their E&S related policies, that might generate shareholder value. And actually, last week in the FT, I read a piece that Mark Mobius is actually launching a fund that tries to do exactly that in emerging markets. Okay, so pinpoint firms that have poor E&S policies and then work to improve their E&S policies, thereby creating shareholder value. Now, another let's say another subset of firms where sustainability might work is in business to customer facing sectors. Okay, so there's a paper by Henri Savès and Tamayo that sort of examines the impact of sustainability on performance by focusing on sort of what they call high customer awareness sectors. Okay, so they find that on average, the good sustainability does not enhance firm value and does not lead to higher performance, but it does so when firms belong to these sectors with high customer awareness. Okay, so then again, this is, sort of a subset of firms, where conditionally sustainability might lead to value. And another example drawing on sort of research I did in 2015 is where I analyze mandatory climate risk disclosure. So essentially, the UK passed an interesting law in 2013 where they made greenhouse gas emissions disclosure mandatory for listed companies. Okay, and essentially, in this paper, I document that this has led to positive valuation effects. That has had a positive impact on valuation, but more so when the firms belong to very carbon-intensive sectors. Okay, such as the oil and gas or the basic materials sector. So it's again let's say a situation where conditionally sustainability might matter. So it might be that the stock market as a whole does not reward sustainable behavior, but for a subset of firms, the stock market might do so. Now, this is kind of echoing some of the remarks that Laura made already. So I think when you discuss the relation between ESG and investment performance, it is very important to know that the relationship between risk and ESG is much stronger in the data than the relation between returns and ESG. Okay, and to illustrate this, I draw on a recent paper with my colleague Rainer Gibson-Brandon, in which we sort of propose a way of measuring the stock portfolio level sustainability of institutional investors. Okay, so the idea is, so we call this this measure the sustainability footprint, and essentially the idea is very simple. So the idea is to combine sort of the portfolio weights of investors, of their stock portfolios, with ranked stock level sustainability scores. Okay, and then simply, calculating sort of evaluated average sustainability of the stock in the institution's portfolio. Okay, so really sort of an average sustainability for the investor. Okay, so the formal definition is, so you take, at any point in time t, you take the weights, of that investor J attaches to stock I at date t minus 1, and you multiply it by, the sustainability score at date t of that stock. Okay, and then you just calculate the weighted average. So it's kind of like calculating a return. Now, the way we do this is we scale it that higher values indicate better portfolio level sustainability. Okay, and what we do next then is we look at a sample of 3,500 different institutional investors in the US between 2002 and 2015. And essentially in each quarter, we classify institutions as having either poor sustainability or good sustainability. Okay, so because we have this measure, the sustainability footprint in each quarter. Okay, so we can classify investors based on that sustainability score, and essentially sort of the first quintile. So these are the institutions with the lowest sustainability, and the fifth quintile are those with the highest sustainability. And what we do then is we compare, or we look at the risk and return of institutions sort of with better sustainability relative to institutions with the worst sustainability. Okay, and I think so to bring across this point that the relation between risk and sustainability is much stronger than that between return and sustainability, I'd like to just show you this graph here. Okay, so this graph shows you, so the dots show you the relative the blue lines, the blue dots, they show you the portfolio return conditional on the level of sustainability. Okay, so the higher the sustainability here, so higher sustainability is going from the top to the bottom. Okay, and what you see here is that essentially if you focus on the blue dots and the blue bars around these dots, which are the confidence intervals, so you see that essentially investors with the highest, so the best sustainability, have exactly the same return compared to those with the lowest sustainability. However, if you look at the red bars here, or the red dots here, which is the relationship between risk and sustainability, so you see that the investors with the highest sustainability have dramatically lower overall portfolio risk. Okay, and essentially if these bars they touch the red line here, this means that there's no statistically significant difference. So essentially for the return, you see there's like no difference depending on the sustainability. So essentially portfolios with higher sustainability tend to have the same returns but much lower risk. So I think it's important to note that this relation between risk and sustainability is much stronger than the relation between returns and sustainability. Now, the second to last point I'd like to bring across is that the effects of E, S, and G are potentially very different. Okay, so ESG tends to be bunched together, okay, in particular by practitioners. But the, as was suggested by a question earlier, the implications or the effects might be very different. Okay, so to explore this, what we do is we sort of calculate a environmental, social, and governance footprint independently, okay, separately. So we spread up, or we spread out the environmental, social, and governance dimension. And I'm going to show you a graph that mirrors the graph from before, where I look at the relationship between portfolio returns and this footprint, the environmental, social, and governance footprint separately. And what you see is that, now why there's no relationship between returns and the overall sustainability footprint, you actually see when you break up the environmental, social, and governance dimension that you do find significant results. Namely that sort of institutions with better environmental footprints tend to have higher portfolio returns. Then secondly, the institutions with the best social footprints tend to have low returns, and there doesn't seem to be a relation between governance and returns, which might be because it's already priced in, right? I mean, there's no. I mean, governance research is very advanced, right? I mean, there's been a lot. Has been said regarding the relationship between returns and the governance footprint. So, it might not be that surprising that there's no relationship between returns and the governance footprint. Okay, so this is just to bring across this idea that I think it's very important to analyze E, S, and G separately and not necessarily bunch them together. Now, the last point is really about reverse causality. Okay, so essentially, there are very few studies that show that ESG has a causal impact on risk or returns. Okay, so essentially, we don't know whether companies perform financially because they are sustainable, or perhaps they perform better in terms of sustainability because they are stronger financially. Okay, so both this view that it's kind of this chicken and egg question where we don't know whether companies perform financially because they are sustainable, or whether they perform better in terms of sustainability because they perform better financially. And I think this is really an area where we need a lot more research, because the majority of the studies that this review article by Alexander Bassen summarizes, that cannot distinguish between these two views. Okay, and I think it's really important, that we identify the exact causal mechanisms through which ESG generates value for investors. Okay, so to finish up, so I think the main conclusion, sort of the main points I would like to bring across to you today is that I think there is evidence that stock markets tend to punish unsustainable corporate behavior. I think there's even quite strong evidence. Then that there are these non-negligible correlations between ESG measures and firm level characteristics that need to be accounted for. So the value implications, or the value of ESG, can depend strongly on the context. Perhaps the industry you are analyzing, whether it's a customer-facing company, or a company or from a sector that is very intensive environmentally speaking. Then that the relationship between risk and ESG is much stronger in the data than the relationship between returns and ESG. And then fifth, that ESG is often bunched together, but this might hide that individual components could potentially or do have very different implications for risk. There are very different implications for returns. And then sort of probably directed more to the academics here, I think much more research is needed to identify these causal mechanisms through which ESG generates value. Okay, so thank you very much for your attention.
We have a couple of minutes. Do you want to take a few questions?
Yeah.
Hi, thanks for a very interesting talk. Henrik Hermansson, Swedish Agency for Growth Policy Analysis. So you mentioned that small firms have lower ENS scores than larger firms, and you mentioned the word bias, right? I was wondering whether you can say a few more words about why that would be. Is it a sort of measurement problems on the part of the rating agencies? Is it an actual performance issue, or is there some other explanation? I mean, we know that most small firms obviously aren't rated at all in terms of ESG.
Yeah, so first of all, I mean, we're talking about small stock-listed firms, so they can still be reasonably large. So I think it has something to do with the availability of information potentially, right? I mean, like if you're a large company, obviously you're much more exposed to media, to NGOs, so mechanically there's more information available to sort of, let's say, an ESG rating agency to assess the sustainability of the company, right? So I mean, I think there's no conclusive piece of research now that has shown that is this a bias or is this due to availability? But I think it's an important element to bear in mind. So in particular, if you have small firms that are very strong in terms of ESG, that's probably a very, very strong signal. I don't know if that sort of answers your question. Yes.
So if being bad on ESG is so deleterious for returns, why not all companies do ESG? I think we should study this financial friction if we want to interpret in a causal way this empirical evidence. All the time I see these papers, this is what I wonder. So I'm wondering whether you have any thoughts on this.
So could you just repeat this? Sorry, I didn't get the beginning.
You seem to claim that the ESG is overall at least correlated with good performance, seems to be good. There is no cost of ESG in what you have shown. Well, so I'm wondering why not all companies do that.
So first of all, I've shown that the main point I was trying to make is that the relation between ESG and risk is much stronger than the relation between ESG and returns, right? And then, so I think that this review article, I mean, like which I'm citing, it shows that there's a positive correlation between returns and ESG, which can be, for instance, driven by omitted factors, right? I mean, that's another point that I made, that, ESG is correlated with, quality as a factor, right? So, now if you regress returns on ESG by omitting quality, you're going to find sort of a spurious correlation. So I think it's I mean, as you're saying, it's very important to better understand, these causal mechanisms. And I think there is a paper now that sort of pushes this idea of frictions, that you are mentioning. So I don't know the exact results, but I can send it to you. Yes.
Hi, thank you. I'm Angelica from ALDC Partnership. My question to you is, what kind of underlying data do you use when you split the ESG to evaluate the returns and the risk graph?
So what I use here is I use MSCI and Asset 4 data, but it is different MSCI data than was used in the previous study. So it's the old Innovest data. So I mean, the idea is that, I mean, obviously there's this debate now on the information content of these ESG ratings. But what we do is we sort of take an average of 2 already, with the idea being that when you take two measurements, it might be better than just focusing on one provider. So we're currently adding more and more measures to it to have sort of a better estimator. But I am aware of the fact that these ESG providers can differ substantially. But actually, if you look at rank correlations, so if you just look at the relative position of firms according to these rating providers, you actually get much higher correlations. Okay, so this is the idea that maybe a score of 80 from one provider doesn't correspond to a score of 80 from another, but the relative positioning, there's more convergence on the relative position when you look at these rank correlations. Yes.
Hi, thank you. Eva Alfredsson, Swedish Growth Analysis. When you were evaluating the portfolio risk return compared with the sustainability footprint. What kind of data for the sustainability footprint did you use?
So we use,
and basically my question is, what kind of studies are there on the relationship with ESG and sustainability in real sustainability issues?
So to answer the second question first, that's sort of this idea of whether having a high ESG scores actually indicates that you are sustainable or not. I mean, there is a study that says by looking at not the data we use, but that actually is very controversial. That might not always be the case, right? So I think there's a lot of work needed to better. Or to find better ways of quantifying sustainable behavior by firms. And I think here there's really a role for regulators as well, to improve the quality of the underlying information. Okay, so for instance, like one of the studies I alluded to is in the UK. So in the UK now, listed firms, the large ones have to disclose their greenhouse gas emissions, which is great, right? I mean, so, the rating agencies have better information, okay? So, if you could do that for other sustainability-related dimensions, that would obviously lead to better, sustainability assessments at the firm level, okay? So that's sort of the second part of the question. And the first part is, so what we use here is we use sort of an aggregated score from two data providers. So we use Thomson Reuters and MSCI, and we combine them, with this idea being that, let's say we take two, well, I mean, obviously we make them comparable, but then, we might be closer to the true sustainability, which we can't observe, right? But, like the idea is, you take two, you take an average, it's already better than just taking one, because, ideally it would cancel out sort of the idiosyncratic biases that exist by just taking one single. But, we can sort of extend that, to using other data as well.